But it's funny, there's that developing acts that much over this, we're developing intrusions from this thing. Yeah. I don't know if I'm making this any safer. There are some features that are bad. Just sticking down.
Good afternoon, everybody. I'm Dan Hussey with Zaner Ag Hedge, bringing you the strategy of the day update for January 16th, 2020. I'm going to have to get used to saying 2020 2 weeks into the year and still not rolling off the tongue like I wish it would. Lots going on today in the markets. Big down day for the corn. Beans showed some follow through to the downside from yesterday's price action. And the wheat did back off of its highs, although probably the most supported out of the grain markets. Live cattle and feeder cattle found a bit of a slide here today, down into fresh lows for the week, but ultimately defended the January low in both of those contracts. And rebounded nicely off of both of the front month contracts, I should say, and rebounded nicely off of those levels that we'll take a look at here a bit later. But real quickly, trading futures involves risk and is not suitable for all investors, and trading with leverage can work for you as well as against you. Everything expressed in this video is my own opinion, and nothing is a direct trade recommendation. Of course, leave your comments and questions below if you have any questions with anything I'm going over today. On the docket, I want to go over, look at corn, wheat, beans, cattle, and live hogs pretty quickly in the charts. Kind of update you with some of the things we've been talking about and some of the technical levels we've been watching. Pretty much one of the two scenarios we've talked about for those markets going higher or lower has played out. So I want to cover what we're seeing, how we listen to what the market's telling us, and then continue to go with that and build a dialogue, if you will, with the market about what's going on. That's the key to trading, I think, is learning how to listen to what the market's telling you. But sometimes, that doesn't mean it always involves price. And I'll talk about more about that when we get to corn and the sell-off here in just a minute. And then after that, stay with me, because I do want to take a look at this heat map I've got over on the right-hand side. We'll take a closer look at it and take a look at the 2017 numbers for what does China import. It's a heat map of their entire import of agricultural products, totaling $121 billion. And I'm sourcing that data from oec.world, an amazing website that, if you've never checked it out, creates the most visually pleasing data representations for global economics and trade that I've ever seen. So very cool website. Got to give them a shout out here for everything they're doing as an organization. And I'll include the links for it in the comment section or below. And then briefly, I also want to talk about a finding about an article from Iowa State University that I have read through, and really like the way they objectively look at how the market could be underestimating China's purchasing power here. And this was an academic article published by the Center for Agricultural and Rural Development from Iowa State University, entitled China's Agricultural Import Potential. And I'll go over that article in a little more detail later when we're talking about the China purchasing potential that the Phase 1 deal represents. I wanted to really break down with you today exactly how China has spent in their agricultural purchasing in the past, and what maybe some of the trends are in those economics, particularly in their domestic demand economics, that could be maybe forecasting some interesting places for new exports from the United States and imports to China of some agricultural products we may not be considering. Because while soybeans is a massive amount of that, it's not there's plenty of other places we can make up that $50 billion in purchasing. So going over the markets here, the March 20 corn contract went out the day down around 376 near its lows. Really ugly day for price action, trading almost 13, but 12 cents down on the day, and a solid 12, almost 13 cents off of its high. Corn has now broken below the WASD low at 376. This was a level I mentioned before that if we were to go below, we might start to see a stop run or that kind of capitulating like run on the market, and down to 371 and 365 prior support levels that proved themselves in December and September are just below. So there's certainly a trend line against these lows holding up, or that could come in and be supportive for the corn market around the November and December clustered low, where we found the rally that brought us into the end of the year and put us, took us from 371 up to 390. We've really just been inside of a trading range in corn that has consolidated down in this wedge-like structure. So at this time, just like the beans, unfortunately, we just have to hang our hats on the idea that it's if we're not going higher, we're going sideways, and if we're not going completely lower, we're still going sideways. So we have some lines in the sand where risk could fall apart to the downside and really break any hope of basing before new contract lows. But it's also been interesting to watch that last week we noticed corn had actually flipped long in that speculative non-commercial position, and going right into this report or the phase one deal signing with a speculative long was not exactly the bullish type of market sentiment we would expect. In fact, this liquidation in the market might be that speculative long rushing out, and once they're done covering out of fear, and on the back of the Mexico potentially reducing their ethanol mandate, I believe that shocked the market here with our biggest exporter of corn or importer and trading partner for corn. There's that fear that international demand might not be there. So keeping a close eye on it. It's a range until it's not. But worth mentioning the downside we saw in corn. And again, we were hoping to see that reversal against that WASD low continue through. It didn't happen. Everything about the market looked bullish until it wasn't. Soybeans. We've been talking about the range between 940 and 960 for the better part of 2 weeks. That range has now broken to the downside. That line in the sand around 940 has given way, and 20 cents to the downside we have fallen towards 921. There is that gap fill from 1213 here from 921 that we have now come down and, in my opinion, somewhat filled. I'm fairly positive that there's at least the conversation of or the conversation worth having of a support level at this area, around this area, because there's of course a 50% retracement from the December low to the January high that is right here at the 921 area. So a pretty corrective structure down, but ultimately what is now a downtrend on a day-over-day basis that we would need to see some kind of reversal for before you really want to commit to the long side here, because remember, when you step back on the beans, we're still in that sideways range, and unfortunately do run the risk of falling all the way back down to 880 and just trading sideways. Wheat, a bit of a setback here today, but did finish off of its lows and is really just testing down into the broken resistance around the 565 area, now testing it as support after breaking up to 578 highs. 50% retracement from Tuesday the 7th low around 545. That's also the January low, so this is a halfway back retracement or 50% pullback for the month. Traded around 561. If we can hold below the 555 lows, as well as this Fibonacci inflection zone, the 50 to 61.8 retracement line, if you can hold support here, price projection should have us going back up to the trend channel highs towards 585. If we don't, we fail and we continue lower. Channel support at this time is around the 555 area, but ultimately, we might be setting back against this larger trend that we've traded since November, in a series of higher highs and higher lows now for 3 months running. So very constructive price action still there in the wheat complex. All right, feeder cattle and live cattle both traded down into the low end of their range here. Feeder cattle real quickly, the 143 area comes in as support yet again in this range that we've been carving out since mid-December. Back above the 147 area, I think is a breakout here for the Jan feeders. And ultimately, we could see the market continue sideways here, roughly holding a trend line. It kind of got back up into its range depending on how you draw it, but point being is that this market seems to be flagging or trying to run on 147 resistance, and of course this is all only valid in my opinion while we're above the January 142 area, the lows there. If we go back below those lows, we're heading back into December's range, and could come back down to the 138 November lows in a larger pullback. The February fats, same range-bound price action we've been talking about for a couple weeks, but I have been trying to remind traders that feeder or cattle do have a seasonal range now for the next month or so, where we typically go sideways. This year we are grinding against the 128 handle and what is now inside price action against December's trading range. So we have this consolidating range going on between 124.77 half or lows today and the 127.55 highs of the month. Finding ourselves right in the middle of that range just to me suggests that sideways pennant structure still forming. Still bullish above, bearish below lows of the month, and believe that we should continue higher towards 129 on a period of price discovery out of this range. And last but not least, the hogs, and we'll get into some of those, talking the synopsis on some of the Chinese data, etc., in a second, and some of their imports and what my thoughts are. The February lean hogs here trading lower on the day, bit of an outside day to the downside, in fact, trading 66.85, back in the range of yesterday, so not really a close outside of yesterday's range. If we can get back above 68 here, certainly price discovery could take us back to 71, as I see the hogs potentially in a range below the lows of November, December, and January here. We could potentially could see continuation lower, and very likely would see a retest of that contract low. So there's your technical updates of our majors here today, and now I think we should talk a little bit about what does China import. I don't think it surprises, or it shouldn't surprise anyone, that 30% of China's agricultural imports are soybeans. The total import value of around 36.6 billion can fluctuate based off of currency valuation, but ultimately is a major and certainly is the biggest portion of what they import. And it's why I think soybeans have been dictating the conversation of the Phase 1 deal. But surprisingly, there's some other products that are could help our ag producers out, like tanned equine and bovine hides. A $4.15 current billion-dollar industry. Who knows? Maybe there's shortages of hides we don't know about. But it surprised me that was such a large industry, or such a large trade, or such a large portion of a decent amount of Chinese imports are these tanned and equine bovine hides. Another surprising one for me was the non-filleted frozen fish. $3.5 billion industry for China's importers, bigger than their red meat, the bovine meat market, about $3 billion in imports. Which the $3 billion in imports, I will admit, actually aligns with some other findings I have here. We'll cover in a minute. But one of the kickers in the hole that I've been talking about recently is obviously the current imports of hogs of 2.17 billion and current imports of poultry of 9.12 or 0.9 billion or 900 million. China does not import that much pork or poultry historically because they've always been able to almost meet their domestic demand. These imports are, I think, generally, I don't want to call them they're inconsequential between pork and chicken, but ultimately over the gross amount that they actually consume, it's actually very small. It's like less than 5% of their total, and both of them in total consumption. So when you consider that total Chinese consumption meets total Chinese demand so elastically, or there's such a good meeting. When one of those industries gets rocked, like the hogs did, and now China's unable to meet that domestic demand, it's driving the price of pork higher, and that has ultimately led in organizations like the USDA to start to
300 yards off
forecast potentially a higher poultry or chicken consumption in China up to the tune of about 15%. That would take current poultry consumption in China about 4 million metric tons above their 5-year average of around 12.5 million metric tons a year in consumption. So right around the 16 million metric ton mark, that's an additional 4 million metric tons of chicken that China is choosing to consume rather than pork because they don't have the pork. So they can either import pork or start eating a different protein if they want to continue to eat meat. In this case, if they continue to eat chicken, their own domestic capacity already meets their demand. So if demand's going to go up by 4 million metric tons, they're going to have to source that from somewhere. And wouldn't you know it, poultry has just gotten cleared recently to actually to start being shipped to China. So we're looking at a potential maybe on the high end, 4 million metric tons, which at a price point of, I used around $1,200 a metric ton, would put that at just shy of $5 billion of additional spending from China that could be added to that balance sheet. And that's just assuming that they outsource all that chicken from the U.S., of course. There's some other things that could go in there, and my math could be wrong, but I'm fairly certain about it. I found an article earlier today that I mentioned earlier in the video from Iowa State University. Again, China's agricultural import potential, or titled, from the Center of Agriculture for Rural Development. What I noticed about this that really stood out to me was on page 5, table 4, the predicting China's import potential for the United States. What they did here was they took a look at both domestic demand in China, domestic production in China, how those two meet, the elasticity of demand, and factored in then basically the need for China to meet any of that elasticity with imports. And then weighing those imports and scaling for various taxes and tariffs as well as costs, they came to the conclusion that on the low end, you could see an increase in import values of pretty much agricultural products from the U.S. to China of 17 billion, on the high end of 53. What stood out to me the most here was the chicken numbers. I actually believe they might be wrong here, and that they're off. The decimal point might need to be one to the left here, where it's about $500 million to the low end, $1 billion in the medium, and $1.5 billion on the high end of additional purchasing. That fits more with the numbers I found in terms of where I feel it could be. But like I said, the numbers I found, you could see it as high as 4.8 billion almost 5 billion there if we see domestic demand spike to that effect, which they did not take account for that much of a demand spike in this model because the USDA only recently has released their consensus for a potential 15% increase in chicken consumption on the back of the need for a cheaper protein. So I just want to call to attention that there are lots of ways we can come to the phase 1 quota. There are agricultural products here, beef, chicken, maybe even wheat, but China already has so much wheat. Beef and chicken, I believe, and additional pork purchasing could really, if you look at this data, you could easily, if they start importing more beef than they had before, because remember, both chicken and beef have basically not been imported to China for the last 5 years or whatever. So it's kind of a new thing for them to be demanding this from the global market. And to my knowledge, I've heard nothing short of that the Chinese consumer has now a heightened or a more evolved palate, right, for red meat. People can afford it on another level there and another scale. And it's becoming an alternative protein source in Asia on another, because of its, rental supply, and obviously now the rising cost of pork makes it relatively less expensive, right? But with all that being said, China is definitely working towards a plan of food independence. No nation, I think, really wants to rely on another country for anything. We'd all love to be self-sufficient. The United States has that card stacked away in their deck. China does not. They rely on the world to supply them with their agricultural needs, and this chart, or this heat map, shows it. The $1.21 billion a year of agricultural imports to China is to feed the people of China in some way, shape, or form. And now that Chinese demand can't meet, or supply can't meet that demand in some of their markets because of lean hogs and the ASF epidemic, you're seeing supply demand shifts across the board. So we don't know how those trade delegations weighed in on all of these changes and came to that conclusion. They unfortunately decided to keep that under lock and key, but we do know that there's definitely the potential, if we see that because of that elasticity of demand from what the fine folks over at Iowa State have provided us, this article definitely shows that you could see the statistical evidence for what past import data and supply and demand data show, that if China can't meet their domestic demand, and if that demand's rising while supplies are falling, going to the global market, we can at least get the scale to see if that $50 billion is a reality, if some of that domestic supply were taken away and replaced with international supply. And with a trade deal with the United States, we're trying to obviously roll out the red carpet to make the U.S. that premier trading partner. China obviously trying to make sure that prices don't explode and run away here if they're going to have to come in and purchase to meet these mandates, or are going to do the purchasing they're promising. They don't want the market to run up higher before they are starting to buy, and they certainly don't want to tip the world off and start a maniac rally ahead of their orders getting filled. So it makes perfect sense to see China keep with rhetoric that tries to walk back on the idea that there's a mandate that we have to buy this much by this time by this, because that would send a shock to the market that I think would have sent the market higher, because we're not getting that, and China's talking about market conditions to these purchases. They're able to talk that book down, and hopefully they will come in and we will see those flash sales and export numbers. If we see all of this translate over the next few weeks and coming months into that, and we see demand for U.S. goods actually picking up, that confidence in the market and a price rationing should occur. The supply and demand models support it. China's demand supports it. The win-win scenario of this trade deal supports it. Now it's a question of whether or not China actually comes through with their promises. So with all that being said, everybody have a great day. I'm Dan Hussey. I'll be back with you next time. You can contact me on Facebook, Twitter. Leave your likes and comments below. Call me anytime, 312-277-0110. Have a great day, everybody, and I'll be back with you as price action develops.
No.